So yesterday we talked about price action. Yesterday we talked about market structure. Today we are discussing good old price action. And price action is where you actually make your money. Price action is where you know and where you learn to enter and possibly exit a trade. But price action is really simple because it's basically market structure 101, but just on a smaller time frame. Once you see price making structure, and we're going to use the same chart, once you see price making structure, if it's in an uptrend, it's making higher highs and it's making higher lows. Once you see that, all you want to do is find that exact move, but on a lower time frame. So I'm on an hourly time frame. I'm on an hourly, and what I want to do is, if I'm looking to buy in, what would I do? I would go into a lower time frame, preferably either the 15 or the 5. So I prefer the 5 just because you can just see more of what's going on. So let's find where we were at on that chart. So we are right here. Look at what you see here on the 5 minute. What do you see? You see price still making structure. Boom, 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 boom. On the lower time frame is where you want to enter. When you see price making structure on the higher time frame, you just want to find that same structure on the lower time frame. But once again, where do you enter? And how do you know when to enter? You know when to enter when price respects itself. So what do we say? On an uptrend, price should respect on an uptrend, price should respect its lows. And on a downtrend, price should respect its highs. So if price came up, made this high, made this low, and made this high, and then it made this low, we would want to see price do what? Continue up. So it would probably be best to either set some type of alert or set an alarm, or even if you're just screen watching, you set price shouldn't break above here, but it also, this is as low as price can go before price is considered a downtrend. If price breaks below this line, you know that price is in a downtrend, but price should continue. So how do we get into a trade and how do we make our money? Once price breaks through that high that we have set, and actually, I'm not even gonna lie, a lot of people say put your areas or do the wicks. I don't really do the wicks. I do the body. The wick body tells the story. Wick do the damage, is the popular saying. So I pretty much just put the line at the candle, and when I see that price is breaking through on that next candle is where I'm gonna enter. So price is continuing structure. So boom, this is where I'm about to enter. And I'm going to put my stop loss to where price shouldn't go again. Price shouldn't go. It should not be coming back down towards this level. And look at that. That's a 1 to 3. Typically, you would just want to do a 1 to 2. Most people just typically do a 1 to 2. But, there are some people on YouTube that tell you, to teach you to, go for the 1 to 3. In this particular case, you would have made however much money you're risking in 2 minutes. I'm sorry, I said in 2 minutes, in 10 minutes. You would have made however much money you're risking in 10 minutes. Some people also do a trailing stop. So with the possibility of them going in, let's just say they caught this move and then they came back down and they was like, I feel like price is going to go up. It could have easily caught a good 1 to 3 on this. It could have easily caught a good 1 to 3 on this. Now, where swing traders come into the play is they look for areas that price has reached before on that higher time frame. So they're going to go to that 4 hour. They're going to go to that 4 hour and they're going to say, where have price came to? What was the next high? If we're down here, they're going to say, what was the next high? And that next high was here. And then you also had a high here. And then you also had a high here. So these are the areas to where swing traders are going to be looking for price to continue. So once again, let's go back down to that 5 and let's look and see what that trade would have looked like. Scroll all the way over. I don't know why it takes me so far over when I do this. So let's just say you would have bought in. You would have bought in here. And you can't say, oh, well, this is hindsight. No, this is what actual traders do. They would have bought in at the open of this candle. They would have put their stop loss right about here. A 1 to 4, a 1 to 6, and then a 1 to 9. Imagine sitting, risking $100 and making how much? 1,000 of one trade, or you risk 1,000 and you make 10,000. This is how swing traders make their money off price action. And for the most part, this entire time, let's just see how long did this take. So if you would have entered in this trade on Tuesday, you would have hit your take profit by Friday. So Wednesday, Thursday, Friday, in 3 days, you would have made $10,000. 3 days, you would have made $1,000, or however much you're risking. That's exactly how swing traders make their money. And that's exactly how they place they trade. They go on that higher time frame. They go on that 4 hour or that 1 hour. They say, okay, price, let me go to the 1 hour actually, because just structure just shows better on that 1 hour. They say, oh, okay, you know what? I see that price has broken. You had a break of structure here. You had a break of structure here. Even if you don't get in there, you had a break of structure here. Boom. And then you had a nice pullback. What do we want to see? We want to see price continue. So what area is price going to need to break through for there to be a continuation? Price is going to need to break through this level. We had a wick breakthrough, and then we had a nice strong candle. So let's just say, and I'm pushing the bar. Let's just say you even buy in off of this candle. Okay, boom. Price should continue. You want your stop loss where price should not go. If price breaks below this low, we are now in a downtrend. So you want to put price there. Then you want to, for a day trade, you'll want to go for a 1 to 2. 9 to 7. Look at that. And then, okay, so what a lot of swing traders do is they will have this day trade placed in the middle, and they'll just take partial profits there, but they'll still have their take profit right up here. And they would have still made all of their money. And they would have only had a little bit of a drawdown. They would have only had a little bit of a drawdown before price just ran off on them. Just ran off. And that's what you want to see with price action. Really, and I'm going to keep it simple. I'm not going to overcomplicate things. I'm not going to load you down, but that's exactly what you want to see. Another thing though, I'm going to tell you when it comes to price action is you have to know your candles. Rejection candles are the bread and butter. Rejection wicks, rejection candles. These are how you know where price is going to go. Once you see price make a high, and then you see this doji or this indecision candle with a long wick, and then you see another one, you can say, oh, okay, the chance of that next candle going in that favor of the direction is slim. So we're going to have a slight pullback. This is the pullback to where the market gains his money to make this next high. And then what happened? Look, 2 more rejection wicks, a pullback. The market's going to get his money. And then what? Look at here. More rejection wicks. We don't want to go that low. We don't want to go that low. Now it's time for us to make our next high. Boom. Boom. Knowing your candle setups, knowing what to look for is also going to help you, because what a lot of people do, what a lot of traders do is they buy in off the heights. Some trader bought in off this big candle. Some trader did that. And then they bought in, they saw price push up a little bit. And then what happened? It probably went and stopped them out. Or they had their stop loss down here, and then they stopped. They closed the trade out themselves before the market took them out because they thought that price was going to reverse. And then what happened? It ran off on them. And then they say, oh, the market is against me. It's not. You just don't understand price action. You never buy in on a height. You buy in on the pullback. You never buy in off the takeoff. You buy in off of the pullback. Or if you're trading ICC, you never buy in off of the indication. You buy in off of the correction. How do you know when the correction is over? You know when the correction is over when you start seeing either rejection candles at the base of that correction. You start seeing a small consolidation. You know when that correction is over once you start seeing market structure build back up to the level where price was going. You know that the correction is over once you see price pull back to a level. Look at here, price pull back to this level, but it didn't necessarily break it. And then you had a nice strong candle in the opposite direction that was bigger than the previous two candles. That's price action. That's knowing your candles. If you're going to be trading, if you're going to be risking your money, you have to know what you're looking at. You have to know what to look for. So I'm going to write it here on the screen. You want to see similar market structure on higher and lower time frames. That's how you know the market is going in your favor, or not even in your favor, in its own favor. You want to see similar market structure on the higher and the lower time frame. You buy in at breaks of structure. You buy in at breaks of structures that fit the trend of the market. Yep, I'm trying to move it. And I'm trying to think, is there anything else? Not really. Not really. That's really it. You gotta keep it stupid simple. I hate saying keep it simple stupid because I ain't calling nobody stupid. You ain't about to call me stupid. So keep it stupid simple. Like market structure. If price is making higher highs and higher lows on a higher time frame, you want to see price make those same higher highs and higher lows on the shorter time frame, and then you want to enter on the breaker structure that fit the trend of the market on that 5-minute or that 15-minute or however you trade. You want to do the same thing when it comes to a downtrend. And real quick, let's just look at that. Let's just look at that. So price made this low and then it made this high. Now let's go down to the 5-minute and see what that look like. Price made this. It made that low right there and then it made that high. And then what happened? What do we start seeing? Look at this. Boom. We start seeing price push down, then start seeing price push up. Now, once we saw this push up, what could we have done? We could have said, oh, okay, so if price were to continue in its structure, price should break below this level and it should keep going, correct? Yes. Once you see price break through that level, then what would you want to do? You'll want to place your buy at the open of the next candle. You want to put your stop loss to where price should not go. If price breaks above this level, the trend is changing, you need to get out. And then what do you want to do? You want to set a good 1 to 2. You want to set a good 1 to 2. If you're a swing trader, you're going to look for other previous levels to where price have risen or dropped, and you want to take whatever trade that or whatever profit that is. But look at that. Easy 1 to 2. All because you saw price action on the higher time frame, and then you went to the lower time frame and you waited to see that exact structure. That is all you do. And in a trade like this, it's amazing. Once again, you had minimal drawdown. So keep it simple. What do you look for? You look for structure on the higher time frame. You drop down, you want to see that same structure. You buy in at the break of structure that follows the trend of the market.